or in the next calendar year. Well, let's focus on Ceat. That's the stock that's buzzing in trade, one of the outperformers post that acquisition that they've done. They'll acquire Camso's off-highway tires and tracks business from Michelin for around $225 million. To discuss details of this acquisition growth outlook as well, we're joined by Anant Goenka, the Vice Chairman at Ceat. Hi, Mr. Goenka. Good morning, and thanks a lot for joining in. Well, congratulations. The street likes what they are seeing with regard to this acquisition. It appears on an EV upon sales, you've done it at around 1.1 times. Could you tell us what is the growth that you're anticipating from this asset that you'll have acquired? And also, I believe that margins are relatively better for this acquired asset. Could you tell us what is the margins for the past year and how do you see this business scaling up?
Yeah, great. No, thank you for having me. And we are very excited about the acquisition. I think the most exciting thing about the acquisition is the brand. I mean, in today's world, getting access to high quality premium brands is a rarity. Getting customer access in EU and US, particularly with high quality OEMs, high quality tractor manufacturers, compact construction makers, and distributors gives us a great entry and stronger position in these markets. We get access to about 40 plus OEMs, and we get access to about 200 plus distributors, and this is at the high-end premium segment of the market. So to us, this is what is most exciting. Also, the OHT segment is generally higher margin than the routine tires business of passenger car and truck, etc. So this will increase our share in the higher segment business. A large part of this business is into tracks. Now, tracks are these conveyor belts that are used in construction equipment or in agricultural equipment, and it is high tech. So in addition to a brand and customer access, we get great quality technology where the number of players in the world are very few. So we're excited about growing the tracks business globally as well. And the synergies out of this acquisition, we feel, are fairly high. Whether it is, for example, once we acquire the Camso brand, we will have Ceat that can sell tracks over time. We can have Ceat entering more and more into the compact construction tire business as well. And Camso, as we acquire the brand in about 3 years' time, we will get access to all categories. We can enter into agricultural tires, power sports, and many more spaces which Camso can expand in the premium end of the market. We also get access to 2 high-tech factories in Sri Lanka, and of course the markets of North America and Europe. So overall, that's the construct, and that's what really excites us. I think the growth of both getting together, really the idea of 1 + 1 equaling 3, is very much possible.
Anant, hi, good morning. Prashant here, and congratulations. We have the last year's number, as my colleague earlier put it to you. Could you give us a sense of what kind of growth rate can we expect over the next many years? And what does it do for the overall Ceat margin profile? If you can give us broad numbers, say FY26 or FY27.
Right. So from FY23 to FY24, the OEM segment has seen some amount of slowdown. So to that extent, we expect this year to be slow. That is current year FY24. Going on to, we get access to the company after all the permissions, competition commission and all of those permissions are through, which will happen in about 6 months' time. Post that, I would say another 3-4 months of, at least 3-4 months of integration, etc. And then we can really start leveraging both the brands. So I'd say the larger effects will come in from calendar year 26, and with that, I think the industry itself is growing at about, say, between 5 and 7%. If we are able to get the 2 companies together and integrated well, I think we should see higher growth than that going forward. In terms of margin, the margin profile of the business is at about 15 to 20% range. In Ceat itself, we are at about 11-12% margins. So to that extent, if you were to look at the numbers, about 2,000 crore revenues coming in on a 12,000 crore base. So some uptick on margins is something that can be expected.
Anant, hi. So just some follow-up questions on exactly that. Like you said, the acquisition, the integration is going to take up to a year, right? You'll get the approvals and then the final sort of synergies will start playing out. So we're looking at a 1-year timeline. before the benefits start coming in. So my question, let's divide that into two parts. The outlook till the acquisition is complete and integrated, and then post. Now, as of now, FY25, there was some pressure on the margins, in the second quarter. Then you did take some price hikes. I think 1st of October, there was some price hikes. So right now, I'm not talking about the acquisition, just talking about the base business. In the second half, what's the outlook? Will you look at pushing forward more price hikes? We were just looking at the PV as well as CV numbers. FADA just put out the numbers. I mean, and CV in particular is hurting really bad, at least as of now, the domestic demand here. So your outlook on the business, FY25, first the base business, and then we'll talk about the blended margin trajectory with this acquisition in the fold.
Right. So about 60% of our revenues come from the replacement market, about 20% from exports and 20% from OEMs. So yes, the OEM segment for us in the CV as well as in the passenger car segment are slower. On the other hand, tractors, two-wheelers are seeing a better growth in terms of the market. Overall, going forward, I think growth will continue to be strong for Ceat because of the positive momentum we are seeing in the replacement segment. In terms of margin, yes, Q3, there will continue to be some stress on the margins. Rubber prices went up from about 150, 160 rupees per kg to about 250 kind of levels about 2 months ago. This has cooled down, and at the same time, we've taken some price increases in October and November. So with some of that, we think by Q4, margins should get better. And then the year after that, things should continue to remain fairly positive.
So when you say better, now I'm talking full year outlook FY25, because you're expecting some improvement in Q4. You'll end the year at what, 12%, more than that, less than that? Just a rough band will help. And also just the revenue growth because of the strong replacement demand. What will be the revenue growth for this year and the margin band for this year?
Yeah, so to share with you, revenue growth until the first half of the year, or say Q2 year on year, was at about 11%. I think this kind of growth levels will be at a similar kind of a range bound. Similarly, margins, I think there will be some dip and some increase. So not much difference in what we've seen in terms of margin, maybe a slight dip from what we're seeing from current levels, say H1, H2, maybe just marginally lower, but very, very close, both of them, growth and margin.
Right. Hi, Anant. Just to get back to the acquisition, then we have got it that it's margin accretive. The ROEs of the acquired business as well, similar to what you're doing currently, 14-15%, if you could confirm that. And also, how do you funding this? It's $225 million, which is roughly around 1,900 crores or thereabouts. So what is the breakup, debt and equity, if you could break that up for us?
Yeah, we're looking at about maybe 30% from equity, 70% from debt in terms of how we plan to fund the acquisition. So your first question, could you repeat that?
The ROEs will be, around 14-15% of the acquired business?
Yes, our ROEs would be, close to around 15% kind of levels. That's largely because what we're seeing is that the amount we have paid would be similar to setting up a new factory. But along with that, we get access to so much more technology, speed of entry into market, brand, etc. And the margins are fairly strong in this category. So we feel fairly positive and excited about stronger growth and returns for this segment.
Anant, there's, Trump takes over in the US. You mentioned those 2 factories in Sri Lanka. The push is to make in America. You think that will make a difference at all? Any risks there?
I think it could be a positive opportunity. I'm not sure if Sri Lanka is in Trump's radar. So to that extent, if he's going to look at the larger fish like China, possibly, I think it's a good opportunity for India, which has a great relationship with the US at this time, and Sri Lanka, which may be just too small at this point of time to be something in terms of taking action on. So I'm still positive about US impact being more positive than negative.
And Anant, final question, just going back to that margin trajectory in the future. Like you said, once the acquisition is done, and this is an entity that is working at higher margins, the track business, etc., 15-20%. So blended margins for Ceat, say FY27 onwards, what's going to be your aspiration band with this in the fold?
That's very difficult to predict so far on. I mean, I'd say 1 year hence.
But realistic assumption and aspiration, because this is a higher margin business that you've acquired.
Yes, largely I would say that 25% of our business will be in the off-highway tire segment. this segment does garner strong margins of around, it could be as high as 20% kind of levels. So the goal will be just to increase our share of business over time in off-highway tire segment. We feel that there's enough upside to grow in the current facilities that we are acquiring. Nearly 30 to 35% higher growth can come in without investing in more capacity. So to that extent, the growth opportunity very much is there. And the whole focus will be how do we further grow it, which will shift the margin profile. So today, if we're at say 12% kind of margins for Ceat, hopefully something higher than that. Very difficult to give a number.
Okay, Anant, very quickly, you did around, this acquired business did around $210 million in the past year. It could scale closer, it could scale much higher from here. The potential of this acquired business could be around 280 to 300 million without putting any further capex. Would that be the broad understanding?
I'd say in the near term, there has been a dip from 210. FY24, or current year 24 calendar year, we expect it to drop. But then in the long term, we expect it to certainly cross the 200 million mark over time. 200 or even go up.
I want to understand, Anant, I'm trying to understand what is the potential, the revenue potential. In near term, there are some headwinds, but what is the potential of this business if you don't have to put any further capex? What could it roughly be? And also, you briefly mentioned about equity 30%. Will you be looking at raising some equity in the, in Ceat, which will be roughly around 500-600 crores?
Right. So the potential clearly is a 250 million plus kind of number.
Got it.
And in terms of equity, we don't plan to raise. We feel our balance sheet is fairly strong. We will be in our ratios of debt equity, debt EBITDA, we'll be within fairly comfortable numbers even after the acquisition.
All right, Anand, we'll leave it there. Thank you very much for joining us. It's a pleasure and good luck. As we said, market, of course, likes what you've done. 7% in the Ceat stock is the biggest mover, meaningful volume-led mover coming through